Welcome back, economic gladiators, to Boss Economics World.
The only show on the internet that treats global economic policy with the seriousness it deserves, as a high-stakes, often ridiculous, primetime soap opera.
Today, we're jetting off to sunny Madrid, where the world's two heavyweight champions of commerce, the United States and China, are locked in yet another round of, well, what are they locked in? A discussion? A negotiation? A staring contest? The official line is high-level talks.
Our very own Treasury Secretary, Scott Bessent, and Trade Rep, Jameson Greer, sat down with Chinese Vice Premier He Lifeng for a cozy 6-hour chat.
6 hours.
That's longer than most Hollywood marriages. When Bessent emerged, looking like a man who just survived a 6-hour root canal, he gave the press the most profound economic insight of the century. We'll start again in the morning.
Truly groundbreaking stuff.
Meanwhile, President Trump, from the comfort of his New Jersey golf course, declared the talks are going fine. Fine is the word you use when your doctor asks how you feel after eating a gas station burrito. It's not exactly a ringing endorsement.
So, what's really going on behind the closed doors of the Baroque Palacio de Santa Cruz? Are they hammering out a new world order? Or are they just arguing over who gets the last show?
Grab your popcorn and your portfolio, because we're going to peel back the layers of this diplomatic onion, and I promise you, it's going to make you cry, with laughter, and maybe a little bit of economic despair. Let's start with the item on the agenda that everyone, from your teenage niece to the highest echelons of power, seems to be obsessed with: TikTok. The app faces yet another deadline this week, September 17th, to be precise, to either sell its US operations or face a shutdown.
This deadline has been extended more times than a struggling Broadway show, with this being the fourth reprieve since President Trump took office.
The official narrative, of course, is national security. The fear is that with its Chinese parent company, ByteDance, the app could be used by Beijing to spy on, blackmail, or censor some of its 170 million American users. A veritable Trojan horse filled not with soldiers, but with dancing teenagers and algorithmically perfected cat videos, poised to undermine Western civilization.
But let's apply a little economic satire here. The president who once tried to ban the app now seems reluctant to pull the trigger. Why the change of heart? Could it be the realization that banning the platform that helped him woo young voters in the 2024 election might be a bad look?
Or perhaps it's the fact that the White House itself launched an official TikTok account in August. It's a classic case of do as I say, not as I do, or perhaps more accurately, this app is a national security threat, but also, have you seen my latest post?
It's getting great engagement.
Trump himself summed up the strategic ambiguity perfectly, stating, we may let it die, or we may, I don't know, it depends.
Up to China. His isn't policy, it's a shrug. It's the geopolitical equivalent of a teenager saying IDK, you up, via text message. The whole saga is a masterclass in economic misdirection.
While we're all fixated on the fate of this social media app, we're being distracted from the far more complex and painful realities of the US-China economic relationship.
The proposed solution, a forced sale, is itself a labyrinth of absurdity.
Any deal would require Beijing's approval to transfer TikTok's prized algorithm, the secret sauce that keeps users scrolling for hours.
China has already indicated it would block such a move, especially after the US announced steep tariffs. So we are stuck in a loop.
The US demands a sale that China won't approve, and extends the deadline again and again, all while claiming it's taking a tough stance. It's a performance for the cheap seats. The most likely outcome of the Madrid talks is not a grand resolution, but another can-kicking extension of the deadline. TikTok isn't the main event, it's the opening act, a flashy, noisy, and ultimately hollow spectacle designed to give the illusion of action. It's the perfect pawn in a much bigger, much more expensive game. Now, let's move from the dance floor to the factory floor. While the headlines scream TikTok, the real knives are out in the semiconductor industry. This is where the economic war gets real, and where the concept of a truly globalized economy is dying a slow, painful death.
Just ahead of the Madrid talks, in a move of perfectly timed diplomatic cordiality, China launched 2 investigations into the US semiconductor industry. The first is an anti-dumping probe into certain American-made analog integrated circuits, or ICs.
The second is a broader anti-discrimination probe into all the measures the US has taken to kneecap China's chip sector.
This wasn't a random act.
It was a direct response to the US adding another 23 Chinese companies to its infamous entity list, a blacklist that restricts access to American technology for businesses deemed a threat to national security. This is the tit-for-tat escalation that has defined the trade relationship for years, a cycle of sanctions and counter-sanctions that feels less like policy and more like a schoolyard fight.
Let's break down China's move, because it's devilishly clever.
They aren't targeting the super-advanced, headline-grabbing AI chips that the US has already restricted.
Instead, they're going after analog ICs. What are those?
They are the boring, workhorse chips. They don't power supercomputers, they manage power in your smartphone, control systems in your electric vehicle, and process signals in medical equipment.
They are everywhere. They are the plumbing of the digital world.
China's claim is that US companies like Texas Instruments and ON Semiconductor are dumping these chips on the market, selling them below cost to crush local Chinese competitors. Beijing alleges that between 2022 and 2024, imports of these chips from the US surged 37% while the average price collapsed by 52%. Of course, this ignores the broader market correction and oversupply post-COVID, but in a trade war, who needs context? This move is significant for several reasons.
1.it shows China is willing to weaponize its own market.
By targeting these commodity chips, China is reminding the US that its companies still rely on the massive Chinese market for volume and revenue. A potential duty on these chips could force global electronics manufacturers to either pay more or redesign their products to use non-US components, causing ripples throughout the supply chain.
2.it highlights the splinter net. This isn't just about trade deficits anymore.
This is about building two separate, competing technological ecosystems. The US has been trying to hobble China's advanced chip capabilities for years, citing military applications. China, in response, is pouring billions into achieving self-sufficiency, and this probe is a way to protect its fledgling domestic industry in the less advanced, but still critical, chip segments.
3. It's a shot across the bow. The message from Beijing is clear: you think you can cut us off from high-end tech without consequences? We can inflict pain on your bread and butter industries.
It's a calculated escalation designed to create leverage in negotiations. This chip war is the real story.
It's a battle for the commanding heights of the 21st century economy.
While the US focuses on preventing China from obtaining the most advanced technology, China is fighting back on the lower end, creating a protected space for its own champions to grow.
The end result?
A fragmented, less efficient, and more expensive technological world for everyone. Your next smartphone, car, or even toaster could be a casualty of this conflict, its price inflated by tariffs and its components dictated by geopolitics. So, we have the TikTok theater and the chip war trenches.
What does it all add up to? This is the surface level of our analysis, the grand theme of our economic opera, the great unraveling of globalization.
For decades, the world operated on a simple premise: make things where it's cheapest and sell them everywhere. This created unprecedented wealth and lifted millions out of poverty, but it also created deep interdependencies. Now, those dependencies are seen not as strengths, but as vulnerabilities.
The buzzword used to be decoupling, a complete economic divorce between the US and China. That proved to be too messy and expensive.
An IMF study projected a full decoupling could slash global GDP by a staggering 7%, the equivalent of vaporizing the German and French economies combined. So, the politicians, ever fond of a linguistic makeover, rebranded it as de-risking. The idea is not to sever ties completely, but to strategically reduce reliance on China in critical sectors like semiconductors, rare earth minerals, and pharmaceuticals. U.S. Trade Representative Jameson Greer has been a key architect of this philosophy, arguing for a fundamental break with China to protect American national security and industry.
But is this de-risking actually happening, or is it just a shell game?
The data tells a fascinating story.
Direct trade between the US and China has indeed fallen. China's share of US imports dropped from over 21% in 2017 to just 13.4% by 2024. By the second quarter of 2025, bilateral trade had crashed to a 19-year low.
On the surface, it looks like decoupling is in full swing. But look closer.
Where is the US importing from instead? Mexico and Vietnam. Their exports to the US have skyrocketed. And where are Mexico and Vietnam getting the parts and capital to fuel this export boom? You guessed it, China.
Chinese investment is pouring into these countries to build factories that assemble goods for the US market, effectively bypassing the tariffs.
This isn't decoupling. This is rerouting.
It's like telling your kids they can't have cookies from the cookie jar, so they just get their older sibling to grab the cookies for them. The supply chain has become longer, more complex, and ultimately more expensive, but the fundamental reliance is still there. The tariffs that were supposed to shrink the US trade deficit have done little to the overall number, which remains stubbornly high. The deficit with China fell, but the deficit with the rest of the world simply grew to fill the gap. This entire charade, the talks in Madrid, the TikTok drama, the chip-for-chip retaliation, is a symptom of this messy, chaotic transition. The old world of frictionless globalization is gone, but the new world of walled economic gardens hasn't fully bloomed.
We are in an awkward, expensive, and dangerous in-between.
As veteran trade negotiator Wendy Cutler of the Asia Society Policy Institute notes, any real deliverables from these talks will likely be saved for a potential meeting between Trump and Xi Jinping later this year. These lower-level meetings are about setting the stage, managing the optics, and trying to keep the whole fragile structure from collapsing before the main actors arrive. But there's a growing sense, as Cutler has pointed out, that Beijing feels it has the upper hand and can withstand the pain better than the US. So, after 6 hours in a Spanish palace, what have we learned? We've learned that global economic strategy is now part performance art, part bare-knuckle brawl. We have a trade war that has escalated from tariffs on steel to a fight over the very architecture of the internet and the digital economy.
The Madrid talks are not about finding a solution. They are about managing the conflict. They are about creating just enough of a facade of dialogue to prevent markets from panicking, while both sides continue to build up their economic fortresses.
The US delegation is there to talk about tariffs, export controls, and even money laundering related to Russia, while the Chinese delegation is there to push back on those very same issues.
Who pays the price for this grand theater? You do.
The American consumer pays through higher prices on imported goods.
The American worker in industries dependent on global supply chains faces uncertainty. The American tech company, caught between two governments, loses markets and faces rising costs. The global economy, fragmented and inefficient, grows more slowly than it should. The tragic irony is that for all the tough talk, the core problems remain. The US still runs a massive trade deficit. China still engages in practices the US deems unfair.
But instead of a functioning global system to resolve these disputes, we have a series of ad hoc, politically motivated skirmishes.
As we await the morning's resumption of talks, don't expect a breakthrough.
Expect more of the same, carefully worded statements, veiled threats, and another can kick down a very long and bumpy road. The great economic decoupling is proving to be less of a clean break and more of a slow, agonizing, and incredibly costly unraveling.
That's all the time we have for today on Boss Economics World.
Remember, in the grand circus of global finance, the clowns are often the ones in charge.
Stay cynical, stay solvent.